Imagine that moment. You've just signed the contract. 7 figures, maybe 8. It's life-changing money.
Absolutely.
You're a pro athlete, you've hit the peak, you've achieved this incredible dream, and boom, generational wealth
Yeah.
right there in your hands.
Well,
Wealth
yeah.
most people, spend their whole lives chasing. It's just pure triumph.
It absolutely is a huge moment. But for this very specific group, this, high-earning group, that victory lap, it tends to be pretty short.
Okay, why is that?
Because the second that ink is dry, the athlete suddenly becomes more than just talent. They become a complex financial entity, generating huge sums across multiple states, often with global reach.
Right, like a small corporation almost.
Exactly. And that kind of enterprise, it needs specialized management, very specialized. Most standard financial advisors, they're just not set up for it. And the clock, this is the critical part, the clock starts ticking loud and fast right away.
Okay, let's unpack that. The critical reality, as you put it. So our mission today in this deep dive is to really get into the unique financial world of these professional athletes, the ones handling these massive multi-million-dollar contracts. We need to understand the challenges, sure, but also the sophisticated strategies, sometimes pretty aggressive strategies that these specialized fiduciary advisors use.
Yeah.
Especially thinking about places known for this, like Stuart, Florida. Strategies designed to make sure the sudden windfall actually lasts.
And you have to start with the core paradox of it all. It's this incredibly short earning window that somehow has to fund potentially the longest retirement imaginable.
Right. The numbers are stark when you look at them.
They really are. Sobering is the word. The average NFL career, just 3.3 years. That's it.
3 years. Wow.
And the NBA is only slightly longer, average around 4.5 years.
So less than 5 years, maybe just 3, to make enough money to support yourself for potentially, 50, 60 years?
Easily. Think about it. You enter the league at 22. Maybe you're done by 25 or 26. That money you made has to last you until you're 80, 85, maybe longer.
The margin for error is basically 0.
Non-existent. And that, right there, explains those terrifying statistics you hear about. We're not talking about a few bad apples making poor choices. It's systemic.
Like what kind of numbers?
Okay, so about 78% of former NFL players experience serious financial distress, bankruptcy, foreclosure, you name it, within just 2 years of leaving the league.
2 years. That's incredibly fast. They've barely had time to figure out what's next.
Exactly. And it's not just football. Around 60% of former NBA players reportedly go broke within 5 years of retirement. 5 years.
Okay, so this just hammers home why the choice of financial advisor is so absolutely critical. It can't just be anyone.
It absolutely cannot. And crucially, it has to be a fiduciary. Someone legally obligated to put the athlete's best interests first, always. Ahead of their own commissions, ahead of everything else. This isn't just like a nice-to-have feature. For these athletes, it's survival. It's the only way they stand a chance of beating those odds.
That fiduciary distinction, that seems absolutely central here.
Yeah.
And it sets us up perfectly for our first big topic, the perfect storm of financial complexities. Why does traditional financial advice just fall flat for this group? What makes their income so unique?
Well, I often think of it as a kind of three-headed monster. You've got extreme income volatility, huge sums coming in, but maybe only for a few years. Then there's intense public scrutiny, which adds pressure. And the third head, maybe the trickiest, is this incredible jurisdictional complexity. It's unlike almost any other job.
Okay, jurisdictional complexity. You mean taxes, right? The jock tax.
That's a big part of it, yeah. The multi-state tax maze. Think about it. Most people earn income in one state, maybe 2 if they move. An athlete, they could earn income in dozens of states, sometimes even internationally, within a single season.
Okay, break that down. How does that actually work? Let's say an NFL player.
Right. So take a player, maybe a quarterback or a linebacker. Over one season, they might play games in, say, 8 different states. Plus, maybe training camp in another state, practices. Every single day, they spend working in a particular state, practicing, playing, sometimes even just traveling for a game that counts as income earned in that state.
Seriously, every single day has to be tracked.
Every single day. And each state has its own tax rate, its own rules, its own filing requirements. You've got California maybe at 13.3%, Florida or Texas at 0%, and everything in between. The athlete's CPA, working with the advisor, has to meticulously track where the athlete was and allocate every single dollar of their salary to the correct jurisdiction.
That sounds like an absolute administrative nightmare. You'd need specialized software just for that, surely.
Oh, absolutely. Highly specialized. And it's not just the team CPA. The athlete needs their own expert team verifying everything. This complexity flows right into the next issue, contract erosion.
Contract erosion, meaning the big shiny number on the contract isn't what they actually get.
Not even close. That headline figure, it shrinks, and it shrinks fast before the athlete even sees a dime of it.
Okay, walk us through that. Let's take a hypothetical $10 million one-year contract. How much disappears?
Right, so $10 million, first Uncle Sam takes his cut. Federal taxes could be up to 37% right off the top.
Okay, so we're already down to $6.3 million.
Instantly. Next up, state and local taxes. Depending on their game schedule, their residency status, this could easily slice off another 5% to, say, 13% or more if they play a lot in high-tax states like New York or California. So you could be looking at losing almost half, maybe even more, just to taxes.
Half the money gone,
Yeah.
just like that.
Yeah.
And they haven't paid their agent or anyone else yet.
Exactly. The agent's fee is typically next, usually 3% to 5% of the gross value. So that's another $300,000 to $500,000 off our $10 million.
Okay, still shrinking.
And then you have what I call the cost of doing business for an elite athlete. Our personal trainers, specialized nutritionists, physical therapists, off-season conditioning programs, maybe high-end insurance policies teams don't cover. These aren't luxuries. They are necessary expenses to maintain the performance that earns the contract in the first place.
So when you add all that up,
Mm.
the taxes, the agents, the essential expenses, what's actually left? What percentage hits their bank account?
It varies hugely, of course, but it wouldn't be shocking if the athlete effectively nets only 40 to 50 cents on the dollar, maybe less in some cases.
40 cents on the dollar?
Yeah,
And that remaining amount has to be managed perfectly to last for 50 plus years.
that's the challenge.
Okay.
So, yeah, synthesizing all this, it's not just about managing a lot of money. It's about managing highly volatile, geographically fragmented income under this immense time pressure. It demands a totally different approach.
An aggressive optimization problem, as you said. Okay, that leads us perfectly into the strategies. Section 2, cash flow and investment strategies for this compressed timeline. You mentioned paychecks often stop in the off-season. That makes cash flow management particularly crucial, right?
Absolutely crucial. It's just the reality of how most pro sports calendars work. An NFL player, their season might end in January. They might not see another paycheck from the team until training camp starts in, July or August.
So 6-7 months with no salary coming in?
Exactly. But the expenses don't stop. Mortgage, car payments, lifestyle costs, continued training. They need to cover all that with zero income for half the year or more.
Which means they need a much bigger cash cushion than, say, a typical professional. Let's compare that. What's the standard advice for an emergency fund?
For a traditional professional, someone with a steady year-round salary, the usual advice is to keep maybe 3 to 6 months worth of essential living expenses in a liquid, easily accessible emergency fund that covers, a job loss, a medical issue, short-term stuff.
Okay, 3 to 6 months. And for the professional athlete, with that high but very volatile income.
The recommendation is significantly higher. We're talking 12 to 18 months of living expenses held in liquid accounts. Cash, money markets, very safe, accessible stuff.
12 to 18 months. That could be millions of dollars just sitting in cash for a top earner.
Yeah.
Isn't that a huge drag on potential investment growth during those critical few earning years? That seems like a massive opportunity cost.
That's the pushback advisors often get. And it's a valid question. Why keep so much in low-yield assets when you desperately need growth?
Yeah. How do fiduciary advisors justify that level of conservatism?
The justification is rooted in mitigating catastrophic risk, that huge buffer. It's not just for the predictable off-season gap. It's for the unpredictable. It's insurance against a career-ending injury tomorrow. It's insurance against being unexpectedly cut from the team. It's insurance against a contract negotiation that drags on for a year, stalling income.
Ah, okay. So if the income suddenly stops, they don't have to panic sell their growth investments, potentially at a huge loss, just to pay the bill.
Precisely. The liquid buffer protects the long-term investment strategy. It's career insurance, essentially. You sacrifice some potential upside on that cash portion for the certainty that a sudden income shock won't derail the entire 50-year plan.
That makes sense when you frame it that way, protecting the core plan.
Yeah.
Okay, now let's flip to the investment side, investment transition acceleration. If they only have, say, 3 to 5 years to build the wealth foundation, how does that warp the usual investment approach?
It completely inverts the traditional life cycle investment model. The strategy has to be twofold. Maximize growth aggressively while you can, but also be ready to preserve capital much, much sooner than normal.
So during those peak earning years, let's say ages 22 to 25, 26,
Mhm.
how aggressive are we talking for the portfolio?
Pretty aggressive. You might see allocations of 60%, maybe even 70% or more towards growth-oriented investments equities, maybe some private equity if suitable. They need that money to compound as quickly as possible because the earning window is so short. They're trying to do decades of wealth accumulation in just a handful of years.
But the key difference you mentioned is the early shift away from that aggression.
Exactly. A typical investor, say a doctor or a lawyer, might stay heavily weighted towards growth well into their late 40s or even 50s. The athlete. They need to start shifting that allocation towards more conservative investments, bonds, income-producing assets, capital preservation strategies much, much earlier.
How early?
Sometimes as early as age 28 or 30, maybe even sooner if the career looks like it's winding down. Preservation starts to become the dominant theme way before they hit what most people consider middle age.
So the transition isn't dictated by their biological age, but by the projected end of their unique short career cycle.
Precisely. You front load the risk during the earning years, then you rapidly de-risk the portfolio to lock in those gains and protect the capital base before the massive income stream dries up. It's a race against time.
Which again requires incredibly careful planning, especially around taxes. That leads us neatly into Section 3, mastering tax efficiency and the residency advantage. You mentioned managing that multi-state maze requires specialized CPAs, strategies well beyond standard tax-efficient investing.
Yeah, standard tax-efficient investing might involve things like municipal bonds or harvesting tax losses. That's basic stuff for these guys. Athlete tax planning is about active, coordinated legal and accounting strategies across multiple jurisdictions simultaneously. These specialized CPAs, they're not just filling out forms, they're strategizing constantly to legally minimize the tax bite across all those states, ensuring every dollar is allocated correctly.
And probably the single biggest lever they can pull, the one advisors really focus on, is establishing residency, right?
Mm.
Specifically, the Florida tax strategy.
Mm-hmm.
Why is moving to Florida, maybe setting up shop in a place like Stuart, such a powerful move?
It boils down to one simple, powerful fact. Florida has no state income tax. Zero.
Okay, and the impact of that.
It's massive. For an athlete earning, let's say, $5 million a year, if they can successfully establish and, importantly, defend Florida residency, they completely eliminate that state income tax burden. If they were previously resident in a high-tax state like California, that could mean saving 10%, 12%, maybe 13% of their income annually.
Let's put a number on that. On $5 million, 13% is, what,
Yeah.
$650,000?
Great, yeah. $665,000, give or take, per year. That's money that doesn't go to the state tax authorities. Instead, it goes directly into their investment portfolio to compound for the next 50 years. Multiply that over a 5-year career. You're talking about millions in retained capital, purely from choosing the right state of residence.
It seems like a no-brainer then. Why doesn't every athlete just move to Florida or Texas?
Well, because it's not quite that simple. There's a huge caveat. Other states, especially high-tax states like California, New York, Massachusetts, they know this game, and they will aggressively challenge residency claims they think are just for tax avoidance. They conduct audits.
So just getting a Florida driver's license isn't enough.
Not even close. You have to prove genuine domicile, that Florida is your true, fixed, permanent home, and you intend to return there whenever you're away. This requires meticulous record-keeping and demonstrable actions.
Like what kind of actions? What does it take to make the residency stick?
You generally need to spend more than half the year, 183 days, physically present in Florida. You need to move your family there, register your cars there, get a Florida driver's license, register to vote there. Your primary bank accounts, doctors, dentists, religious affiliations, ideally they should all be centered in Florida. You need to build a clear pattern of life that points unequivocally to Florida as home base.
And if you don't do it right, if the audit goes against you,
You face potentially paying all the back taxes you thought you saved, plus steep penalties and interest. It can completely wipe out any benefit, and then some. That's why working with advisors and CPAs in Florida who know the specific state requirements and the audit triggers inside out is so vital. They help build that defensible case from day one.
got it. So residency is huge. What else on the tax front? The compressed timeline means they have to max out everything, right? Retirement account maximization.
Absolutely. Every single tax advantage dollar counts double when your earning window is so short. So, yes, maxing out any available 401k plans, IRAs, HSAs, that's table stakes. But for athletes earning millions, those contribution limits are tiny relative to their income.
Right, a $20,000 or $30,000 401k contribution is a drop in the bucket if you're making $10 million.
Yeah.
So what else? What supplementary vehicles do they use to shelter more significant amounts?
This is where it gets more sophisticated. One common tool is cash value life insurance, or CVLI, and it's used less for the death benefit, more for the savings component.
Okay, life insurance as a savings tool. How does that work specifically for an athlete? Why is it advantageous?
Several reasons. First, the cash value inside the policy grows tax deferred, similar to a retirement account, but without the strict contribution limits of a 401k or IRA. This allows them to shelter significant sums. Second, they can typically access that cash value later in life through policy loans, which are usually tax-free, providing a source of supplemental retirement income without triggering a big tax bill.
Interesting. Tax-deferred growth and tax-free access.
Exactly. And third, it provides a permanent death benefit. Remember, when an athlete leaves their team, they often lose access to any group life insurance or disability coverage they had. A personally owned CVLI policy provides that continuity of coverage, which is crucial protection for their family alongside the tax advantage savings. It solves multiple problems at once.
So it's a kind of tax-sheltered investment wrapper that also plugs a potential insurance gap post-career. Very specific to this situation.
Extremely specific. The goal is always efficiency, tax efficiency, investment efficiency, protection efficiency. Every dollar needs to be optimized.
And speaking of protection, let's pivot to Section 4, asset protection and estate planning nuances. With sudden massive wealth and high public visibility, athletes become targets, don't they? So this planning goes beyond wealth transfer, you could say. It's fundamentally defensive.
It's almost entirely defensive, especially early on. For a 25-year-old athlete, the primary risk isn't usually estate taxes yet. The immediate risks are lawsuits from accidents, bad business deals, whatever, and unfortunately, often financial demands or bad advice from family, friends, the whole entourage. Protecting the wealth from current threats is priority number one.
Okay, so how do advisors build that fortress? What are the key tools, the specific trust structures they use?
Trusts are definitely the bedrock of the defense. You typically see a combination of three specific types deployed pretty consistently. First, there's the Irrevocable Life Insurance Trust, or ILI.
Okay, connecting back to the CVLI we just talked about.
Precisely. By placing that cash value life insurance policy inside an ILIT, the death benefit proceeds are generally removed from the athlete's taxable estate. This maximizes the wealth passed on to heirs later and provides creditor protection for the policy itself during the athlete's lifetime.
Makes sense. What's the second type? You mentioned multi-generational thinking.
Right, that would be the Generation Skipping Trust, or GST. Because the wealth is often created so rapidly and so early in life, advisors are thinking long-term from day one. A GST is designed to hold assets for the benefit of grandchildren or even later generations, bypassing the children's estates for estate tax purposes. It preserves the wealth across multiple generations, minimizing future tax erosion, planning for grandkids when the client might only be 23.
Wow, okay, thinking very far ahead. And the third type is the direct shield against lawsuits.
That's the Asset Protection Trust, or APT. These are specifically structured, often using favorable laws in certain states or even offshore jurisdictions, to shield the assets held within the trust from the claims of potential future creditors. So, if the athlete faces a major lawsuit down the road, maybe a business venture fails, or there's a liability claim, the assets inside a properly structured APT are generally beyond the reach of those creditors. It's like liability insurance for your wealth.
These trusts sound powerful. We also hear about athletes setting up LLCs or corporations. How do those business entities fit into the defense and planning picture? Is it just for running side businesses?
They serve a crucial defensive role first and foremost by channeling different activities, endorsements, investments, maybe a small business venture, charitable work through separate limited liability companies, LLCs or S-Corp. You create legal separation. It compartmentalizes risk.
So if, say, their restaurant investment goes under, the creditors can only go after the assets within that specific restaurant LLC, not the athlete's main investment portfolio or their home.
Exactly. It contains the liability to that specific entity, shielding their personal wealth. That's the primary defensive benefit. The secondary benefit is tax and administrative planning. These entities provide a structure for managing diverse income streams, tracking business expenses, and potentially accessing certain tax deductions related to their brand or business activities.
So the complexity isn't just for show. It's a necessary defense mechanism tailored to their unique risks and income streams. But managing all these trusts, LOCs, investments, taxes, it requires serious coordination.
Which brings us to Section 5, building and coordinating the professional team. Who plays the quarterback role here? Who keeps all these specialists on the same page?
It absolutely has to be the fiduciary financial advisor. They are the central coordinator, the quarterback calling the plays. Their job is to synthesize the input from everyone else, the sports agent negotiating the contract, the specialized tax CPA handling the multi-state filings, the estate planning attorney drafting the trusts, the insurance specialist placing the policies, the investment managers handling the portfolio. The advisor brings it all together. Because the agent might be focused solely on the biggest possible contract number, right? And the CPA might be focused only on minimizing this year's tax bill. But the advisor has to see the bigger 50-year picture.
Precisely. They have to ensure those short-term wins don't sabotage the long-term financial security. And this coordination gets really tested during contract negotiations. That's where you see contract negotiation synergy, or the lack thereof.
Meaning the advisor needs to be involved before the contract is signed.
Critically involved. The advisor needs to work directly with the agent to evaluate different contract structures, not just on the total dollar amount, but on the timing of payments, the guarantee structure, the tax implications. They model it out from a long-term financial perspective.
Can you give an example of how a contract that looks great on paper could actually be problematic?
Sure, let's use the classic backloading trap. An agent comes back excited. We got you a $50 million 5-year deal. Sounds amazing, right?
Sounds pretty good, yeah.
But then you look at the structure. Maybe it pays the league minimum for the first 2 years, say $1 million each, and then it jumps to $24 million in year 4 and $24 million in year 5. Heavily backloaded.
Why is that structure potentially bad, apart from having to wait for the big money?
Several reasons. First, it creates huge cash flow problems in those crucial early years. The athlete is trying to establish residency, build up that 12, 18-month emergency fund, get their initial investments going, and they're living on minimum salary. Second, those massive income spikes in the later years trigger enormous tax liabilities all at once, potentially pushing them into the highest brackets and losing more to taxes overall than if the income was smoother.
Ah, okay. So the advisor might argue for a flatter structure.
Yeah.
Maybe slightly less total money, but paid out more evenly.
Exactly. The advisor might push for, say, $8 million a year for 5 years, $40 million total instead of the backloaded $50 million, because that flatter structure provides stable cash flow for planning, smooths out the tax burden, and might actually result in more net wealth accumulation over the long run, even though the headline number is lower.
So the advisor needs to be the voice of kind of long-term financial reality, sometimes pushing back against the agent's focus on the big splashy number.
It requires real conviction, yes. And this need for coordination doesn't stop after the contract is signed. The final piece is adaptability through communication. An athlete's life is incredibly dynamic.
Things change fast. They get traded to a team in a different state.
Right. Suddenly, their entire tax plan might need an overhaul. Residency status could be questioned. Or they get married, have kids, land a huge new endorsement deal. Their team changes its benefits package.
So the plan needs constant updating.
Constant. This requires regular structured communication between all the team members, the advisor, CPA, attorney, agent, often through formal team meetings. When something changes, the advisor needs to quarterback the response immediately. A trade happens. The CPA needs to project the new tax implications instantly. A new business opportunity. The attorney needs to set up the right LLC structure before money changes hands. It's about rapid strategy adjustments in response to a constantly shifting landscape.
It sounds exhausting, honestly, which leads us to the ultimate goal of all this frantic activity. Section 6, retirement income planning for half a century, funding 50, maybe 60 years of retirement. You said traditional models are obsolete.
They're completely inadequate. Most retirement planning software is built around a 20 or maybe 30-year retirement horizon. For an athlete retiring at 30 who might live to 90, you need a plan that accounts for a much longer period of inflation eroding purchasing power, the risk of outliving the money, longevity risk, and critically, the sequence of returns risk.
Sequence risk, meaning a bad market crash early in retirement, can be devastating.
Devastating. If you suffer big losses right after the income stops and you start drawing down a depleted portfolio, it's incredibly hard to recover. So the portfolio has to be built for resilience and sustainable withdrawals over a very, very long time frame.
Okay, and there was a surprising wrinkle you mentioned regarding Social Security strategy. You'd assume someone earning millions would easily max out their Social Security benefits, right?
It seems intuitive, but it's often not the case. Social Security benefits depend not just on how much you earn, up to the annual maximum, but also on how long you work and pay into the system. You need a certain number of work credits, typically 40 quarters or 10 years of work.
So because their careers are so short, even if they hit the maximum taxable earnings each year they play, they might not actually accumulate enough work credits to qualify for the maximum benefit.
Exactly. They might fall short of the required credits or just barely qualify. So careful planning is needed. Coordinating with the Social Security Administration, understanding the optimal time to claim benefits based on their overall financial picture, it becomes another piece of the puzzle, maximizing even this relatively small but guaranteed income stream.
Every little bit helps when you're planning for 50 years. Okay, so how do they build the investment portfolio itself to generate income for that long, the multi-layered income portfolio? What does that look like?
It has to be a diversified engine designed for both potential growth and reliable income generation over decades. It can't just be aggressive growth anymore.
So what are the key ingredients?
You'll typically see a significant allocation to high-quality dividend-paying stocks. These provide a steady stream of income that tends to grow over time, helping to combat inflation, regardless of the day-to-day stock price fluctuations. Alongside that, you need a core holding of fixed income bonds for stability and predictable cash flow.
What about real estate? We hear about athletes investing in property. How do real estate investment trusts, REITs, fit in? Are they preferred over owning buildings directly?
REITs often play a crucial role, yes. They offer exposure to the income streams and potential appreciation of real estate, which can be a good inflation hedge, but without the headaches of direct property ownership.
Headaches
Like being a landlord, managing tenants, dealing with maintenance, property taxes, and crucially, lack of liquidity. An athlete who's retired young might need flexibility. Owning buildings directly ties up huge amounts of capital and is very illiquid. REITs, on the other hand, can be bought and sold relatively easily like stocks, offering diversification across many properties and passive income. They fit the need for income and flexibility better in many cases.
Okay, that makes sense. And we're seeing more alternative investments used too.
Yes, definitely. Especially as the portfolio matures and the focus shifts more heavily towards income and preservation. Things like private credit funds, certain types of hedge funds focused on stable returns, maybe infrastructure investments. The goal is often to find income streams that are less correlated with the volatile public stock and bond markets, adding another layer of diversification and predictability to that long-term income plan.
It's a really sophisticated, multi-layered approach built for extreme endurance. Okay, let's shift gears slightly to wrap up. Section 7, Modern Management and the Stuart FL Advantage. We've discussed the complex strategies. How does technology actually enable all this high-stakes, real-time management, especially for athletes who are constantly on the move?
Technology integration is absolutely essential. You can't manage this level of complexity effectively without it. Modern wealth management firms specializing in athletes leverage some pretty sophisticated planning software. It goes way beyond just tracking account balances.
You mentioned scenario modeling earlier. Can you give an example of what that looks like in practice?
Sure. Advisors use software, often employing Monte Carlo simulations, to model thousands of possible financial futures based on different variables. What happens if the athlete gets injured next season and only receives their guaranteed money? What if their career lasts 2 years longer than expected? What if market returns are flat for the next 5 years? What if inflation spikes?
So they can actually see the potential impact of different events on their long-term plan.
Exactly. It helps quantify the risks and makes the potential consequences of, say, overspending today much more tangible. It helps the advisor and the athlete make better decisions about savings rates, risk tolerance, and lifestyle choices by stress testing the plan against various potential realities. It's dynamic risk assessment.
And for the athlete who's, living out of a suitcase half the year, how do they stay connected and on top of things?
Mobile technology is key. Secure client portals and specialized mobile apps are crucial. They allow the athlete to see their updated financial picture 24/7, track their spending against the budget they've agreed on with the advisor, which is huge for behavioral coaching, and communicate securely with their entire advisory team from anywhere in the world. It closes the distance gap and helps maintain financial discipline on the road.
Okay, finally, let's loop back to the geographical edge. We've mentioned Stuart, Florida a few times, as our sources often do. Why does a place like Stuart become this kind of hub for this specific type of high-level financial expertise for athletes?
It's really a convergence of several powerful factors. The most obvious one, as we discuss, is the tax environment. Florida's lack of state income tax is a massive draw for high-earning athletes looking to establish residency. That naturally pulls the clients there.
So the advisors follow the clients or the clients follow the advisors?
A bit of both. The advisors who specialize in maximizing that residency benefit set up shop there, and that expertise attracts the athletes. So you get this concentration of both the client base and the specialized advisors.
Makes sense. What else contributes?
Second is proximity and lifestyle. Stuart offers a high quality of life, but it's also strategically located within easy reach of major sports cities like Miami, Orlando, Tampa. This makes face-to-face meetings with athletes, agents, and team personnel much easier logistically.
Okay. Tax, location. Is there a third factor?
Yes, and it's really important. The collaborative ecosystem. When you get a high concentration of experts focused on the same niche clientele, fiduciary advisors, specialized CPAs, trust attorneys, insurance gurus, all dealing with complex athlete situations, they tend to collaborate. They share insights, challenge each other, cross-refer cases. It creates this environment where the strategies being used are constantly refined, tested, and kept at the cutting edge. It becomes a center of excellence specifically for navigating these unique challenges.
So boiling it all down, the key to financial success for these athletes isn't just finding someone who can get good investment returns or save them some tax. It's about finding that quarterback advisor who builds a comprehensive defensive strategy tailored to that ridiculously short timeline and the absolute need for 50 years of funding.
That's exactly it. The hierarchy is strategy first, defense and risk management second, and optimizing returns third. The best advisors, the ones thriving in places like Stuart, understand that sequence. They build robust systems designed to withstand the inherent volatility and scrutiny of an athlete's financial life.
Okay, so as we wrap up this deep dive, let's just quickly recap the core pillars we've hit. Navigating that incredibly short career timeline, mastering the multi-state tax nightmare, accelerating wealth accumulation while simultaneously planning for an early shift to preservation, and the absolute necessity of ironclad asset protection right from day one.
And maybe the toughest part, the one we touched on but is so critical, the behavioral finance aspect. Perhaps the biggest job for these advisors in Stuart is helping a 22-year-old who just signed for $50 million understand the true long-term cost of their desired lifestyle, helping them see beyond the contract hype to grasp the actual wealth required to sustain that lifestyle, potentially without earning another dollar for the rest of their life. That reality check is often the hardest but most vital conversation.
Getting them to connect the dots between today's spending and needing income in the year 2075. It's the difference, really, between ending up in that tragic 78% statistic and achieving genuine, lifelong financial security. I want to leave you, our listener, with a final thought to chew on, something that really struck me from the sources we looked at today.
Okay, let's hear it.
We spent a lot of time talking about how these elite athletes, multimillionaires, with intense but short careers, are strongly advised, mandated, really by their expert fiduciary teams, to keep 12, even 18 months worth of living expenses in totally liquid, safe cash reserves. As insurance against the inevitable bumps and shocks in their careers, they sacrifice significant investment growth on that cash pile for maximum safety.
Right, that huge buffer.
So here's the thought. If the experts demand that extreme level of financial conservatism, that much readily available cash, that much sacrificed growth, from someone earning millions, what does that level of prudence imply about the risk tolerance you should have? And perhaps more pointedly, what does it suggest about the depth of the emergency preparedness you should be practicing in your own financial life, even without the extremes of pro sports?
That's a powerful point, thinking about that massive safety net they require. It definitely puts our own emergency funds and risk exposure into perspective, doesn't it?
A sobering lesson in financial prudence for all of us.
Something to definitely mull over. Thanks for joining us for this deep dive.